Good evening, everyone. Welcome to the webinar. This is brought to you by Admiral Markets. My name is Chris. Nanette, of course, and I are going to take a look at today's topic regarding the euro. What kind of future does it have, not only this next year, but in the intermediate and long-term future? Before we dive into this topic, please be aware that the video and the webinar now is shown to a global audience, but may not be suitable for everyone. Please visit admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity for more details. Also, please be aware that trading for exchange and global financial markets is considered high risk. Please seek the advice of an independent financial advisor for more information on that. This webinar is for informational and educational purposes only. By continuing watching this webinar, you agree with this disclaimer and you are aware of the risk involved when trading. All right. Thank you so much for your attention on these two disclaimers. Nanette and myself, Chris, we're going to be diving into this pretty big topic. Unfortunately, 1 hour is quite tight for such a broad, well, not broad, but deep topic, I should say, actually, instead, because this is looking at a currency block where 19, I believe, nations are taking part, and there's a lot of analysis that you can do to review it and see how it's doing and what could be improved. So we're going to make it really condensed and really to the point. I will be talking about basically analyzing what the performance has been of the euro to date, and are there any ways to improve it, and what kind of ways. And then Nanette will take over, and he's going to take a look at some euro charts, take a look at the graphs, technical analysis, look at the euro against multiple other currencies, and see what's going on with regard to the technical side. So, all right, first of all, let's dive quickly into understanding the fact that there are a lot of opinions out there, all right? And many, are quite sensitive to this topic because they attach to the Eurozone, basically, and the euro, the fact that whether the EU succeeds as well, right? So there's sometimes a bit of emotions going on. Nanette and I want to explain to you that we want to provide you with the best analysis possible, trying to remove the emotional side out of it, all right? So that's what our focus is, and if any part, you feel like it's not well represented, by all means, feel free to write us a comment or email. We're most welcome to feedback about your views, of course, as well, all right? Second of all is the fact that we should be open. If we want to make good forecasts, we have to be open to data, and we have to be aware of confirmation bias, all right? If we want to be neutral and be able to make the best predictions, we cannot be looking at data and looking at developments with a bias and not allowing us to adjust that, right? If we look at a certain topic and we see confirmation every time in what we believe in, this is becoming not so maybe scientific, but more of a bias or a belief system, in fact. And then it could become very difficult to debate about and find common ground. So the first thing we have to do is be open to information and be self-critical and try to find the truth as best as we can. All right, so that's why you keep that in mind when we discuss the Eurozone performance and other things. It's not because we dislike the euro, it's not because we think the euro is a bad thing, but we're trying to be as honest as possible when analyzing it, all right? And if we do that, then when looking at the data, we have to admit that the Eurozone performance has been weak. All right, that doesn't mean that the euro is a bad idea. The euro, has brought some advantages. But if we look at the economic performance now in end of 2016, since already almost 20 years, then we should conclude, I think, and there are some that are going to be disagreeing with this, but I think we can say that it's at least to be cautiously, we could say it is at least failing at the moment, all right, or slightly failing if you want to be a bit more positive, all right? We cannot say at this moment that it is succeeding or a success already. All right. So is it a failure right now? I think that is too soon because there are still ways that the Eurozone can improve. And if the policymakers would be looking at the signals and adjust their direction to build a better currency block, there could be definitely ways to get out of it and improve and work towards a better future. All right, so it's not the end yet. It's still a process. It's still happening right now, and there are ways to go forward that will improve. We think that could improve at least the performance. All right, from our humble opinion. So what those things are, we'll talk about that in 10, 15 minutes from now. But if you look at the performance so far, you could almost say it is a lost decade. Since the financial crisis started in 2008, the Eurozone has really not been able to recover much if you compare it to the US. The GDP in the left lower corner, you can see that the US GDP in the last 2 years has been significantly and at times substantially higher growth rate than the Eurozone. Also in the right lower corner, you see the unemployment rate just finally dipping low at 10% level, but that's still a staggering number. That is actually the peak that the US had about 6 years ago, and in the meantime, the US is well below the 5%. So if you look at it from an unemployment rate point of view, it's double as much. That is an enormous figure. If you look at the right upper corner here, you see certain countries like Greece and Spain into the 20s, other countries well above the teens, others between 8 and 10%. Those are very high figures, and those are a lot of people. All right, so looking at that, these two criteria, it is difficult to make any other conclusion. Now, if you disagree, we would love to hear from you, but that's our thoughts. So now, why? Now, the next question is why. So if that's the conclusion, why, and what's happening, and how can it be fixed, right? Of course, this is our view at the moment. So now we compared the EU to the US. So the US, of course, this is a different kind of context. The US is one country, one language. EU is really more diverse, more languages, more cultural backgrounds, just a very mixed bag compared to the US, all right? The budget as well, the fiscal policy that the US can do in Washington is way more than Brussels. So they can do much more fiscal stimulus. It's 20%, whereas GDP, of the GDP, the EU 1%, Brussels 1%. So basically, Brussels cannot do much fiscal stimulating of the economy compared to the US. And lastly, monetary deals are not easy. All right, this is a project that is quite ambitious. We have to realize that when the first steps were made to create this, there were very good intentions behind this. There were ideas to solidify and create a prosperous and peaceful Eurozone and European continent, all right? But at that time, they also realized it was going to be a difficult project. If you look at the US, even the dollar had some struggles at the beginning. Monetary arrangements are certainly not so that they always succeed. Look at the golden era where, then they got rid of the gold standard, and then there was the monetary arrangements between the 40s and 70s. So these things are flexible. So that could happen to the Eurozone too. So just because we have the euro right now in Europe, parts of Europe, doesn't mean that that's a done deal. You got to make it work. You got to work actively on managing that. All right, that's something that we must realize. And is that happening? That's a big debate. All right, so I think we can all agree about the fact that the performance is not as good as we think. Even in Germany, by the way, Germany is often seen as and cited as a good performer, but relatively speaking, yes. compared to the other Eurozone countries. Yes, that's true. But then relative speaking maybe to the past, relatively speaking, if you compare Germany now, the last 10 years compared to Italian performance of the 90s, as far as I remember, or the US performance is not that great, right? So relatively, yes, absolutely, not that great really, actually, right? So now the question is why, and there could be a lot of debate and differences between why people think that it's not performing. You know, you're going to hear the Troika, all right, ECB, IMF, right, and they're going to be explaining that it is basically the periphery of Europe that is not performing, not implementing the advice well enough. Okay? The other side is going to be saying basically, well, the institutions, the ideas behind, the rules and regulations behind the shared currency were not sufficiently set up to handle such a wide, diverse area with one currency. Also, one could wonder, they say that basically the ideas about spending and investment, although they share a lot of commonalities, they're not the same, right? Maybe in one country they are more keen on social projects, where in other countries maybe less so. So even within Europe, although they are quite comparable compared to maybe other parts of the world, there are differences that might explain different expenditures. Other countries might want to expend something more on, for instance, on social security, whereas other countries might want to do that less. So even though those ideas are relatively shared, there could be differences on that. So you have different opinions out there. One saying the peripheral countries were not, well enough implementing the ideas from the Troika, and the peripheral countries may be saying that, the regulations, institutions are keeping us from rebounding, are keeping us from moving forward. Now, what is our opinion? Now, I would like to explain that basically I read recently The Euro and its Threat to the Future of Europe from Mr. Stiglitz. And I must say that that case is a very compelling case, what he has written in his book. It's about 300 pages. And he really makes a strong argument there that the rules and regulations and institutions that were supposed to support the Eurozone were really not sufficient. All right. So in this case, it would seem from our point of view that the Troika is incorrect. All right. The regulations and institutions were just not there to be able to handle such a diversity. So let's dive into that a bit more. When a recession hits, how do you respond? Because recessions happen, so what kind of policy tools do you have to react to that? So you have exchange rate, right? But if you have a Eurozone, you can't devaluate your exchange rate. So Greece and Italy in the past their currencies would weaken and they would remain competitive. That isn't possible compared to other Eurozone countries when there's a euro, because that means there's a fixed exchange rate. And here you can see in the right corner what that fixed rate was. There's a limited fiscal policy solution too, because if you're a Keynesian economist, you are actually subscribing to the fact that when there's a recession, governments should spend more to compensate the demand, the decrease in demand, and government should save more for kind of bad times when the economy is going well. All right. So, but the budget rules, primarily driven by Netherlands and Germany, stated that there should be a very cautious approach to fiscal stimulus. All right. So there was very limited scope in that regard as well. Was there a monetary solution available during a recession? Not really, because there's one common interest rate, all right, and the ECB is taking care of the monetary policy for all Eurozone countries. All right. So when the euro was doing well, all right, it was performing okayish, right? It was doing decently, but it was a time of boom, and it didn't really hit any headwinds, right? There was no big wave coming at it, so the boat really wasn't tested properly in rough times, in rough storms. While the 2008 recession was certainly a rough storm. It was a huge wave. And it looks like that the Eurozone was just not able to handle that big wave and impact because it did not have, for the peripheral countries, there was no way to adjust to this shock in an adequate manner. All right. That is basically what the people who say that the institutions were lacking are saying. All right. The main focus was basically, sorry, I'm going in the wrong direction here. Excuse me. There we go. The main focus from the Eurozone was control of inflation, keeping the debt and budget in control. All right. That because they wanted to converge the economies together. They wanted to make sure that the economies were all looking very similar to each other. That was basically the main focus. But is that a focus that indeed has led to a rebound in the entire Eurozone? And so far we see no. Now, the Troika, of course, will say that maybe the solutions that they have proposed, for instance, structural reforms, austerity, and internal devaluations have not been sufficiently implemented. But all of their forecasts so far have been wrong. Anytime they predicted a bounce in the economy, they have been shy of that. All right. Now that might recently have changed. So I'm not saying maybe always is a strong word. I would like to double check that, but in a large number of cases. All right. So if those forecasts are always going wrong, can you say that the medicine is really sufficient? Is it really the patient that is, doing the wrong, making the situation worse? Or is it the medicine basically, right? Is there a bit of confirmation bias problem perhaps surfacing here? Those are question marks. Everyone is going to have different answers there. And it is a very broad and difficult topic. All right. So don't get me wrong on that. But when forecasts are that often wrong and more institutions are saying austerity historically has not given the solutions that are really driving growth and prosperity and a rebound in the economy, when historical data shows that most of the time austerity does not work, with some exceptions when exchange rate was working in their favor. Shouldn't it be time maybe to reanalyze the policy of austerity? Shouldn't it be maybe time to look at the fact that internal devaluations are difficult? If you want the economy to adjust downwards by making prices lower, by making wages lower, that is such a difficult process. There are many things that are difficult with that. Companies will not reduce prices. Workers would rather not take a wage check cut. It's easier to fire people. In many cases, when the GDP decreases 25%, like with Greece, the money floating around in the economy just decreases and services industry gets hit. So that has a kind of like domino effect, right? It's not only so that there are export products that might become cheaper. That could be possible, of course, if eventually prices become lower, which is the goal, but that has such a negative impact on the entire economy that everything gets dragged down. So it's very difficult to adjust downwards. Economy is better if it slowly goes forward, slight inflation of 2%. So for the entire Eurozone, it would have been better for Germany to have actually run a bit of an inflation, let the wages increase there, they would become slightly less competitive, and Greece would stay, and Italy would have stayed a bit more competitive as Germany kind of goes forward a bit, rather than have Germany damp down on inflation and wage growth and Greece and Italy devaluate their economies. And you can see here in red the Euro countries, and look how much the real GDP has changed in 8 years, negative, for all these Eurozone countries in 8 years. Normally speaking, the economy goes forward, right? Or at least by a bit. Not as much as China or India, of course, or other emerging countries. They grow a lot faster, but slightly. And look at all these Eurozone countries in 8 years, not only no gain, but losses. In green, you see the countries that don't have the euro. And you can see significant gains, and in any case, no losses. So think about it, right? Is the focus of inflation enough? Or should there be at least an attempt to look at growth in employment, like in the US? The Eurozone does not do that. They only look at inflation. Should growth and employment be part of the focus of the Eurozone? So obviously, this is, in this analysis, we're providing our opinion as well. But I do want to add that that's because we look at the data and that's our honest opinion at this moment. But we're open to new information. We're open to new developments. We're open to new things. This is our opinion at the moment. But as I said at the beginning, good forecasters are always willing to reanalyze and review and don't get stuck in their opinions. So if there's information out there that others, that you think contradicts this or shows the opposite, we're very willing and open to look at that. All right? And we'll gladly hear from you. And if things change a year from now, here too, we would gladly look at adjusting our opinion. But based on the current situation, more and more evidence is pointing to this direction. All right? From our perspective. Okay, so the other thing is that there's a creditor and debtor debt relationship. So some countries they need to get money back, others need to pay back. That has strained kind of the relationships within the Eurozone as well, and has kind of lost the common goal of moving forward. So there are some difficulties at the moment, as you can see. So solutions. Someone's asking about the sound. I hope the sound is okay. Can people please check and write a Y or yes? Is the sound okay? Okay, great. Thank you. So, solutions. Well, basically, at this moment, the Eurozone is in a halfway state. In a certain degree, I agree with Mr. Stiglitz that said it's either going to be more Europe or less Europe. And when the Eurozone was actually initiated and the Euro came to life, it seems like that the creators realized that more political integration was needed for the Eurozone to be a success. And perhaps that the Euro was seen as the catalyst that the political integration would occur after. So rather waiting for political integration and then create the Euro, the thought perhaps was that we have the Euro and then political integration will come after that, right? But so far, it hasn't really. There's been a significant backlash against further political deeper integration of the EU. And there is an increasing unpopular headwind that already existed even decades ago. In Britain, there was a lot of skepticism, but even in other places, in Holland and France, against the Constitution, uh, there were already signals from the population towards the political elite, let's say, that integration at a too quick pace might be unwanted, right? The EU was a great project, but people, I think, looking at some of these polls in the past, were signaling that take your time. And it doesn't seem like there was a real voice to that there was no, that the leaders didn't listen to that. So after that, this weak economic performance in the last 10 years, the high unemployment rate, in a way, the lack of democracy, and we could have another webinar on that. That's more of a political issue, but there are critics out there that say that the EU lacks legitimacy via a democratic process. Now, that has improved over the years. The European Parliament has more powers, but critics are still not totally satisfied with that. But that's a whole different debate there. Let's just leave it at that for the moment. But these are some of the weaknesses that are facing the Eurozone and the EU at the moment in general, right? So it could be very difficult if the Eurozone is at the moment a halfway state, and further integration might be needed for the Eurozone to succeed and the Euro to succeed. It could be a bit late. It could be a bit difficult when you consider these factors, right? And in that case, one might wonder, is it feasible? Is it possible to push further integration to make the Eurozone succeed when you face these obstacles? And let's remember that the Eurozone itself, the Euro itself, should not be the main goal. It's not, the main goal should never be save the Euro at all costs, because the Euro is a mean to an end. The Euro is a method to enhance the economic prosperity in the European Union and the Eurozone members. If it doesn't, then it kind of loses its purpose. So we shouldn't twist around cause and effect, right? Because eventually the Eurozone might be seen as the goal, whereas the Euro might be seen as the goal, whereas actually it's a middle, it's a method, right? All right, so that might be tough, right? That bigger integration. But if it is done, what things could you think about, right? Now, this is quite complex. I really don't want to dive into all of these things. If you're interested in this, once again, I would recommend taking a look at the Euro and its threat to the future of Europe from Mr. Stiglitz, who won the famous award. I forgot the one in Norway. Sorry, I forgot the name at the moment. I have a blank out at the moment, but a very famous award. Maybe someone can help me in the audience here what the name is of that. But yeah, you can read more of that, the solutions for further integration. Here are the main things: a banking union, mutilation of debt, common framework, structural realignment, promotion of growth and full employment, commitment to shared prosperity. All right, so that's kind of the commitment United Nobel Prizes. That's what it was, by the way. All right, finally thought about the name. So these things you got to think about. I'm not going to dive into that. We don't have time for that now. It's too complex. But these are the things you got to think about then if the Eurozone is going to integrate further to kind of push it in the right direction, according to Mr. Stiglitz, to kind of save it and make it prosper. All right? If you don't do that, because of the lack of political unity, the criticism from the population, then what solutions are left? Well, basically, let's think of other options first of all. Basically, you could continue with the same path. That basically means meddling without any real solution, just meddling forward, right? With no, maybe some smaller solutions. But yeah, that could be problematic, right? Obviously, this is the easiest because it pushes real decision forward. Inaction is always easy when making forecasts. You know, looking at inaction, looking at the scenario when nothing changes, is not a bad way to start, right? Because it is, from looking at it from a path of least resistance, it's often a very simple way to go forward. So that could easily happen. From a politician point of view, they're risking their political careers. It's difficult to get support throughout Europe, in their own countries for changes. Change is difficult in general. So could be a very, it's not the best solution probably, but it's probably a very likely one. Reform of the Eurozone, that was the last slide. Difficult, right? Other things, well, the Eurozone could break up. At this moment, I don't think that is very likely. That's always, percentages are always difficult, but I would say in the next 3 years, I don't attach a high percentage to that. I didn't think about it beforehand, but if I have to do it, I would say, it's a good question. What would you say? Let's do a poll. I would guess there's maybe a 20% chance, 15 to 20. So it's not very likely in the next, let's say, to 2020. But obviously, if there's no solutions given, that chance might start to increase, right? So what do you think is the chance of a breakup in the next, up to 2020? Breakup of the Eurozone. The other solution is a flexible euro. That means that there's a bit more exchange rate flexibility between the euro, so that now it's fixed, but everyone stays in the euro, but there's a bit more flexibility possible. That's another solution. So those are some other options, right? A full breakup, a flexible Europe, everyone stays in it, but at flexible rates for the moment, and then later on maybe fixed again. A reform or continue the same. This is very likely, but could give problems to the future. This is very difficult, but has the highest chance of saving the euro. This could do well as well, and this is probable eventually if the anti-establishment, the anti-euro and EU sentiment continues because of inaction, because of dismal performance in the economy, etc. Other solutions might be a euro continuation, but in a different shape. There could be a north-south eurozone, Germany and Holland leaving, for instance, maybe other countries right away, or Greece, Italy, and Spain leaving. So one idea would be make the euro stronger by kicking out the, let's say, peripheral countries. The other could be kicking out the core countries, and therefore taking out the heavyweights out of it. So the euro is in a way more equal in value with the remaining countries. It will be weakened, of course, but that's good actually for a rebound of those peripheral countries that get a competitive advantage compared to Holland and Germany and maybe some other countries that will join in the exit, or just right away a north-south split of the euro. All right. So in general, I mean, the next 3 years is quite a short time frame. How the Eurozone will be able to make it structurally 10, 20, 30, 40 years from now. Of course, that's a very long time frame ahead of us. A lot of things can happen. A lot of decisions can happen. But looking at the performance so far, it is, things will have to be probably done to enable a successful continuation on that time frame, in my opinion. So let's see how the things develop in the next few years. They could be very critical for the long-term future. All right. There are a lot of political events next year, indeed. such as French elections, presidential and legislative elections in Holland and Germany. Those are going to be important. Founding members of the EU are going to have political measurements. So I have to see how far the, let's say, anti-EU parties achieve in their in these elections. All right. So, well, if you're interested in more, this was maybe already enough for you. But if you're interested in more details, just write us an email. Add code Euro. We're going to dive into some more forecasts about the Euro, the Eurozone, and the general economy in a webinar right here. My email, add code Euro, and that will be for free. All right. Now, with that said, I'm going to give you just a second there to write maybe my email, and then Nena's going to take over, take a look at some Euro charts. This is fundamentally the picture at this moment, at least from our perspective. Facts and opinions there presented to you. But how does it look technically? What can we expect from the Euro next few months, next year? And Nenad is going to do that right now. Hi, Nenad. I'm not sure, Nenad, if you're talking, I don't hear you at the moment myself. Does anyone else hear you, Nenad?
Let's see, the sound should be okay now.
Yes, I hear you now. Great.
Excellent. As always, a great introduction to everything that might happen, but I hope that definitely Eurozone will survive in some form. And for me, for example, I will tell you what I usually look at. So the thing is that first of all, Germany is the most important country in Eurozone, of course, with France. But let's say that the king of Eurozone is Germany. So in order, I will be maybe a little bit more technical with this, but I hope that you will get a point. So first of all, if you want to track how Germany performs and generally how the major force in Eurozone is going, you should be definitely pay attention to DAX in 2017. There is also the difference between DAX and Fed, and there is now a divergence with both being hawkish or dovish. For example, DAX would be bearish if Fed is hawkish, because when US increase interest rates, it means investors can put their money into bonds or fixed income for higher returns than before. And that will cause investors to leave risky assets such as stock markets. Also, you can track earnings in the DAX. You can do that every quarter, and it's a small index. It's only 30 companies, and it should be definitely very easy for you to track it. And also, you need to read about market capitalization of each DAX company. In order to see or to market capitalization, you need to go to this website. I will paste it now. Okay, so this is the website, and here, guys, you can see the capitalization of each DAX company, and also you need to pay attention to price earnings ratios for each DAX company. In German, they call it KGV. Okay, so KGV, okay, I will write it down. KGV equals to price earnings ratio, okay, in German. So you should be paying attention to that. Now, if you don't know what price earnings ratio is, I will try to explain it as simple as I can. Let's say that price earnings ratio is also like saying how many years of earnings does it take to pay back the price. So a company with a price earnings ratio of 14 is like saying it takes 14 years of earnings to repay the price. So remember, earnings is the amount a company earns for the year. Okay, so you can track DAX here. It will be very important, really guys, it will be very important for Eurozone, and pay attention to that, okay? Ilya is saying, curse Jevin, where I don't know to read German, but I don't know what KGV is for. So yeah, track it there, definitely pay attention to it, of course. And you also know what happened to Greece. Greece had a spiral of doom for debt, but the thing is, Greece is not the only one who had debt. And I really think, guys, this is my personal opinion, they will never get out of the cycle of debt unless they go their own currency and they value their own currency to create inflation and pay their debts away. That will be their ultimate escape from debt. But they are very scared to do it because it's a high risk approach. And there is no politician in Greece that really has the courage to do it. Unless, guys, you live in Balkan, let's say, countries, most of European countries, public debt is very high. In Balkan, it's like these parts where I used to live and where I live currently, public debt is very low and economies can grow. So really take into consideration public debt. Greece, Spain, Italy, okay, public debt is very high, and for me, in my own opinion, really they need to, I mean, for Greece and maybe for other countries, they need to go with their own currency, devaluate their own currency to create inflation and pay their debts away. So that is, of course, this is me being an economist speaking. So that is what I think can be escape, okay? Of course, you need also to pay attention to corporate bonds. For example, if ECB is buying corporate bonds, it means more money supply, okay? But what does it mean, more money supply? More money supply means less investments available, because again, debt crisis is in Europe, okay? Less investments, more money supply, because the debt crisis is in Europe, okay? So pay attention to it. Also, guys, you need to keep an eye on equities markets, gold and bond yields, okay? Pay attention to that. As I said, participation rate, it's the percentage of people of working age group that are actively employed or looking for work. If participation rate drops in Eurozone, that means that workforce will be smaller. That is smaller economy, okay? So definitely, guys, I'm very sure, and you need to know that Western economies are full of debt, and demographics is getting worse. Demographics in Western economies is starting to have aging population, and that is not okay. So now probably someone will ask me, okay, Nenad, but how can you know that euro might strengthen, and how might you actually know that euro will strengthen? Okay, guys, I have my own theory here. First of all, I told you once that euro strength can occur if there is a banking crisis with no bailouts, okay? So billions in euros can be destroyed when, and will be destroyed when, the debt is written off. And that will happen during the crisis. If it happens, of course, if we see a banking crisis with no bailouts, then euro might get strengthened. But if ECB can bail out the banks, well, I don't think it can actually strengthen the euro. So what can happen is, I mean, I don't know if it will happen in 2017. This is what I think, is that they split the currency in two. Northern Europeans get stronger currency, Southern Europeans get weaker currency, because then European zone might work. As for now, it makes no sense economically to work. For example, if really a small economy now joins and went on euro as their main currency, that country wouldn't be competitive because euro is too strong. Tell me, guys, how is Greece and Spain going to reduce unemployment with such a strong currency? They cannot devalue the currency, and wages are sticky. I also told you once that sticky wages, it's a term we use in economics. They don't go down quickly during economic hardship. They usually stay flat. If there is no currency devaluation, if we don't see a currency devaluation and wages don't drop, then the country is not competitive. Okay? Think about it, guys. Really think about it. Ilya is asking, well, should I your advice to switch all trading accounts to dollar? No, Ilya. No, really no, I don't think so. I personally switched from dollar to euro. So I really hold my accounts in euros now. So you should be definitely safe. Don't forget that Admiral Markets is FCA regulated company. Whatever happens with UK will negotiate trading arrangements and trading deals with European countries and outside of European zone countries, so you should be safe, really. I personally have all my accounts in euros, so I mean, people who decide about these politics, they know what should be done, but I don't see if they will have the courage to do that. So these things that I've been talking about, I will be paying attention to those things. That is very, very, very important. Deutsche Bank, guys, is very important. The latest information that I have is that Deutsche Bank was worth like 17 billions, and it was worth like 40 billions at the start of 2015. Now, if you watch it, their CDS rates, okay, they suggest that Deutsche Bank and UniCredit Bank are the riskiest bank, okay? Also, don't forget that Deutsche Bank, being the strongest German bank, right, they have derivatives exposure the size of Germany's GDP times 7. And because they have CDS rate as high, the banks rank them the highest to default. But I don't think that they will get default, because if they're close to default, in the worst case scenario, Germany might nationalize the bank. That will save the bank, okay? I don't think that euro will I mean, if it happens, probably it will dissolve into two currencies. But now, I mean, I don't see that it might happen at this point, okay? Also, this is my prediction for euro-dollar, and of course this is midterm prediction, what might happen in next let's say 6 months. Well, guys, I don't particularly like to actually predict midterm, but technically this is what I see. First of all, I will be paying attention. This is midterm, okay? Don't follow this as a swing trade, whatever. This is what I see. This is strong resistance, 1.0875 to 85. This is strong support, 1.0150. I think that with how things have been developing so far, I think that euro-dollar might be still sold on rallies. okay, sold on rallies. So what can happen in euro dollar is that euro dollar goes up gradually and then starts to go down. More likely euro dollar will be pressurized towards parity. Don't forget it, 1.0150 is strong support. If it drops below support, guys, well then definitely it will open the way to parity. That is a ultimate psychological support for a pair, but I don't see it now at this point lower than 1.0150. I mean, there will be probably pressures to pull it down towards parity, and highest for next 6 months I see 1.0875 I mean, from the current standpoint, that is from the current standpoint, okay, don't get me wrong, 1.0875 if nothing is changed in next 6 months, this should be the highest point, this should be the lowest point. Ilya is saying, I invite you to come to live in Switzerland. Well, probably, I mean, who knows, we never know, but we would like to come to Switzerland, maybe hold a seminar or two for people who are actually, who would like to invest and earn with trading. So why not, Ilya? We will see. I mean, everything is open, but definitely, guys, low debt countries, I prefer countries with lower debt, because really Western economies are full of debt, and that is not good. I mean, that is really not a good thing for any economy. Also, guys, what I would like to say is that for all of you who trade euro dollar, 2017 should not change any major trend. So we will have, of course, opportunities to buy and sell, because from trading perspective, you can always enter a buy trade, get 20, 30, 50 pips, right? And get out sometimes even more. But generally I expect really that from current standpoint that euro dollar is actually sold on rallies. Also, you can see that quantitative easing actually purchases decreased, but in reality they were extended for longer duration. Okay, and every single moment you need to watch definitely what algos are doing on that kind of news releases. So pay attention to numbers on quantitative easing, because those numbers are traded by algorithms, okay? And when those news leak out, euro dollar will move a lot. So ECB quantitative easing purchases per month will also move euro dollar heavily in 2017, okay? I also think that dollar will maybe get, I mean, this is my opinion, that it will get stronger in 2017. So given the current risk-on sentiment, money has been flooding equities after Trump's indication to lift fiscal spending and implement tax cuts. Yields have been rising in the US as funds left fixed income for risky assets like equities. We could see crowding out effect, lifting borrowing rates in the US when Trump proposed infrastructure spending. If it actually takes place, it will be good for dollar long term. So I expect also dollar to get stronger. That will reflect on euro dollar currency pair being weakened, okay, weaker definitely. So pay attention to those things, okay? I don't think that China will go into recession, okay? Because if China goes into recession, it will drag the rest of the world into recession, okay? So I don't think that it might happen, because it will spur probably a new GFC, okay? So that is definitely, guys, what I had for you to say, and I will definitely leave some of the forecasts for next week, but for this time I gave you a hint of what can happen in Eurozone, what might happen with Euro-Dollar, what should be the range on Euro-Dollar technical in next 6 months. But of course, all these midterm forecasts are subject to change because politics and major macroeconomic news can change each month. Thank you guys for listening to us. Thank you for being here. Darshan is saying, Merry Christmas, have a great New Year, my friend. Thank you, Darshan. I wish you a Merry Christmas, Happy New Year, and all of you guys have a great New Year. We also published schedules for new webinars, guys. Here, if you trade, if you're still in pound-dollar trade, now you are 20 pips in profit. So you might actually you might cut it now, take some profit, scale out, whatever. So don't worry about pound dollar. Someone asked me about pound dollar, so you might actually cut your profits, take some of it, put your stop to break even. So that's from previous session recap. That was a live trade. So yes, guys, that is what we wish to you. A great new 2017, and spend it in joy. And I hope that we will have even more pips next year. At least what we had for this year. I hope that it will be a continuation of the trend. So thank you. I hope that we will hear from you soon, guys. Everything that you need to ask us, anything is not clear, just send us an email and we will reply. Thank you for listening. We wish you a great day, week ahead. Talk to you soon. Cheers, guys. Trade safe.